Have you been waiting on the sidelines for mortgage rates to fall before making your next move? If so, today's update might come as a bit of a surprise. Even though there has been a lot of talk about Bank of Canada reducing its rates in the recent past, the real story behind the scenes is a bit more complicated. And frankly, a lot more riskier for anybody looking to lock in or make a move right now. Fixed rates, it's increasingly looking like they have already bottomed and they are going to rise from here, at least for the near future. If you're planning a renewal, a new purchase, or thinking about just locking in your current rates, timing is becoming incredibly important. In this episode, I will walk you through exactly what is happening in the economy, why it is driving rates higher despite the slowdown, and more importantly, what smart borrowers should be doing right now to protect themselves. So let's get into it. Firstly, it makes sense to maybe start off with the discussion about the generic economic backdrop that we currently have. Bank of Canada is widely expected to reduce rates soon, and maybe we might see a decrease in the June meeting. That is because Canada's economy has been showing clear signs of weakness. But it is not just here at home. We are seeing a global trend of slower economic growth and probably even recession fears. Inflation has been moderating, and that is a good news. But now there is a growing risk that inflation could return even as the economy struggles. And that could lead to a situation that is known as stagflation. One major trigger for this is, of course, the US tariffs, which have and will raise prices on imported goods and potentially reignite inflation at a time when the economy can least afford it. If they lower interest rates to try and grow the economy, then they risk pushing inflation even higher. If they raise rates to fight inflation, then they risk deepening the economic malice or cause a recession. So it's a catch 22. And unfortunately, central banks do not have effective tools to deal with it. So, in situations like this, it often falls on the government to step in with fiscal measures to try and stimulate growth. But again, it comes with its own risk, which is too much spending could not only lead to higher deficits, but also fuel more inflation fire. In short, if you're heading into a stagflationary environment, it will be a very precarious and tricky time for the economy, especially for mortgage borrowers who are looking to do some kind of transaction right now. Now, just to get a general sense of what these interest rates are doing right now, let's talk about bond rates to start with, because that is where we are seeing some really unusual but important moves. Normally, when the economy slows down or cools down, investors rush to buy safe assets. And when you talk about safer assets, these are generally bonds because they're considered as safe as compared to equity or stock. The rush to buy bonds generally pushes the bond prices higher. And as a result of the price interest rate action or the correlation that they have, the interest rates tend to move lower. Now, since bonds are considered safer investments during uncertain times, we should generally see some kind of move of that nature right now. Higher bond prices usually mean lower interest rates, which usually means that it helps push down the fixed rate mortgages as well. But interestingly, that is not what we are seeing today. Instead, we are seeing bond yields rise, which is the opposite of what we would normally expect. I think the one major fear is the fear of massive future government deficits. The US is planning, or at least trying to continue with the massive tax cut that they have been talking about. But at the same time, they're dealing with higher government deficits. In Canada, major political parties also showcased large deficits in their election platforms. the Liberal Party being the highest. And if history teaches us something, it's that the real deficits turn out to be usually much, much higher than the projections. And market knows this, and it is making them nervous. When investors worry about huge government deficits, they obviously want to be compensated when they are buying these government bonds. And the higher compensation comes in the form of higher interest rate to compensate for the extra risk. Higher deficits also mean a lot more of the government bonds are flooding the market in order to fund their spending. And that in turn puts downward pressure on the bond prices and upward pressure on the interest rates or yield as they are commonly known. Now, let me quickly explain the relationship for those who are not familiar with this concept. So, bond prices and the interest rates associated with these bonds move in opposite directions. When bond prices go down, interest rate or yield goes up, while when the prices go up, the interest rates go down. And mortgage rates, especially the fixed rate mortgages, are directly tied to these bond yields. As of now, the 5-year Canadian bond yield is about 35 basis points or 0.35 percentage higher than the first week of April. The technical charts are just suggesting that we might have seen the bottom in terms of the fixed rates or the bond yields. And if that is the case, we could be looking at increases over the next few months. Now, of course, the elections are over and the Liberal Party has won. And so we can expect higher deficits from the government as per the party platform. So the market has already been anticipating such higher deficits and they have risen ahead of the actual election victory. Now, let's talk about how this is all flowing through to the mortgage market. Well, let's start with the variable rate mortgages. Even though Bank of Canada is expected to cut the policy rates, and the expectation right now there's maybe 2 or 3 cuts this year, and maybe no changes in the coming year. So obviously, this is going to lead to lower prime rate, but lenders have already been reducing the discount that they are offering on new variable rate mortgages. Most lenders have in fact shaved their discounts off by 10 to 15 basis points, or in percentage terms, 0.1 to 0.15% recently. Well, this is just a continuation of the trend that started in October 2024, and I suspect that we are going to see further reductions in the coming months. The reason, of course, for this reduction in the discount is lenders are pricing in more economic uncertainty, and so the spread is increasing. So, what does it mean in simple terms? Well, it means the existing variable rate borrowers will benefit from any drop in the prime rate, which is expected in the coming months. But the new borrowers may not get as good as a deal as before. Talking about fixed rate mortgages, well, the longer term, like the 3-year or the 5-year terms, have been moving higher over the past few weeks. Since early April, we have seen increases of about 0.1 to 0.15 percentage or 10 to 15 basis points across many lenders. And based on the strength that I'm seeing in the bond yields or the bond interest rates, it is likely that we are going to see further increases in the weeks and days to come in. So the takeaway here is simple. Fixed rates have likely already hit the lowest point in this cycle, or at least for the near future. And so if you were waiting for lower interest rates before you maybe renewed your mortgage or did a refinance or made that purchase, you might have already missed the boat. Now, what is done is done. Let's talk about what you should actually be doing today. If you're an existing borrower and if you're currently in a variable rate mortgage and have been thinking about converting to a fixed rate mortgage, I think this is probably the best time to reach out to your lender or bank and see as to what options are available. If you're currently in a variable rate and planning to stick with it, well, that's also totally fine. But just know that locking into a fixed rate at a later point might not seem that attractive in future. That's because we are probably going to see a bigger gap between the fixed and the variable rate mortgages in the coming months. If you're coming up on a renewal, a 3 year or a 5 year fix would be a very smart choice if you're looking to balance flexibility and protection from rate volatility. Well, if you're a new borrower and have the flexibility and stomach some risk, a variable rate could still work out, but the cost benefit isn't that favorable. You could still benefit from lower rates for the next 2 years, but then it's you can anticipate an increase afterwards. If you're a new home buyer and your budget is tight, you of course need the certainty of fixed payments. And so locking into a fixed rate mortgage right now could save you a lot of stress later on. One last but critical point. If you don't already have a rate hold for a fixed mortgage, or if you haven't secured a discount on the variable rate mortgage, then you need to act quickly. Do not sit around waiting for lower rates before you take any action. I have seen many clients recently who hesitated, thinking rates would come down only to be caught having to accept higher rates or worse discounts. It is not a fun situation to be in, and it is completely avoidable with little proactive planning. With most lenders or banks, you can actually benefit from the lowering of the rates if it happens to be before your closing or maturity date. The simple truth is, if you care about your interest rates and the cost, you need to take an action right now. If you're not too concerned, or your mortgage is pretty small enough, and you're focused on the big picture, you can relax a bit more. But if rates and monthly payments matter to you, waiting is not your friend in this environment. Before I close today's episode, I want to make something really clear. Everything I shared with you today is based on the best available information or the projections that we can make as of now. While these are educated predictions about where the market can or might go, markets are generally unpredictable. Unexpected events, policy changes, or shifts in economic data can easily change the path forward for interest rates. Nothing in this episode should be taken as financial advice specific to your situation. It's always important to talk to a mortgage professional or your advisor, whether that's me or someone else that you trust, or talk about your personal goals, your budget, your risk tolerance before making any decision. As they say, predictions are helpful for planning, but flexibility is the key for thriving. So, to wrap it all up, we are heading into a period of higher uncertainty with inflation risk, recession fears, political change, and massive government deficits all colliding. Fixed rates have likely bottomed, and bond interest rates are telling us that higher rates could be around for a little while. Meanwhile, lenders are tightening discounts on new variable rate mortgages, making it harder for new borrowers to get the deals that we just saw a few months ago. If you are sitting on the fence about your mortgage, now is the time for action. Not a few months from now, when the landscape could be tougher. Reach out to your mortgage professional, and if you need a second opinion, I'm happy to help. Get a rate hold, lock in your options, and stay ahead of the increase. Thanks again for listening to Getting Your Shit Together. If you found today's episode helpful, please share it with someone who might benefit from it. If you're ready to get your mortgage strategy in place, do not hesitate to reach out. I'm always here to help you make smart, confident decisions. Until next time, stay smart, stay proactive, and stay in control of your financial future.